Afternoon and welcome to our webinar. This webinar is hosted by the McDougall Wealth Management team at National Bank Financial. I'm Kit Richmond. Just want to introduce myself. I'm an advisor here on the McDougall team. I have a background in investment, corporate finance, and entrepreneurship, and was a competitive athlete for 10 years in the sport of cross-country skiing. I also completed my finance degree in Colorado. I look forward to sharing some information with you today. So we're here today to discuss your pension options letter and the choices behind that letter. So let's get started with our agenda today. So on our agenda, first item is what is commuted value. So we'll go through sort of the definition of what commuted value is and also the calculation that is there to create that value. We'll go over it in a very, very high level. Some of the details you can ask me in the Q&A, or we can talk at a later date about. The second thing is, what are some of the key trends that are affecting defined benefit plans and also lump sum calculations. So we'll go through those. There's been a lot of changes in the last 10 to 20 years in the pension space, and so it's important to talk about those. The third thing is, what are your personal considerations? What are your goals and objectives that have to do with your pension and your income after your employment situation has changed or ended? And the fourth is some of the tax consequences. We do have a tax professional on our team, so I'm not going to answer those with a lot of specificity, but we can answer them in sort of generalities as far as what would normally occur in most situations. And we talk about your specific circumstances if you'd like after. And then at the end, we'll have the question and answer period, and then we have our legal disclaimer and a couple other things to show you. So with that, let's get started. So you received your pension options letter. Basically, this pension options letter is going to give you a couple of different items to look at. You're going to have the option to keep the pension, the defined benefit pension yourself, just for yourself and your spouse, and choose usually the percentage of that amount that you can give to your spouse if you were to pass away, and then that spouse would receive some of the monies. Or the third would be to take the cash commuted or lump sum value of the pension out right away and manage it yourself. So those are sort of the three options that you really get in your pension option letter. Now the key is that the defined benefit plan, you have a set amount of benefit for your whole life, and then your spouse or your survivor. Whereas with a defined contribution or a lump sum that you take out, that is within your control and can be a bit different. Now a lot of people like the defined benefit plan because it does give you some security for your lifetime. So that's something to consider in this situation. So when we go through lump sum value and some of the trends that are happening, we'll go through here what that calculation looks like, and then also some key trends in the next 2 or 3 slides of what's affecting that calculation and some of the changes in demographics and lifespan and other things that can really move the chess pieces on the board so that you can have a different situation for each person, and also changes to whether or not you want to do a lump sum or stay in the defined benefit plan. So we'll go on slide number 6 here. So it looks pretty busy at the beginning, but really the simple math of it is you're getting paid today for all the future payments that you would have had. So how do they determine what you would have had? Well, they take the future value, which is estimated of all the benefits there, number 3. They take R, which is a discount rate, and they take the number of periods. So how long they think that you're going to be, having those payments. So when you combine all that, you get that present value number. Now, R is often called the discount rate, and that rate is an actuarial assumption that's based off of usually the bond market or the Bank of Canada rate. So if that rate gets bigger, then the lump sum goes down. If that rate goes down, then the lump sum gets bigger. That's some changes within that. There's been some changes that have happened in the last few months that have made it that lump sum payments will be most likely smaller in the future and not bigger. The number of periods where you're supposed to get your expected payout, that is usually related to an actuarial assumption of lifespan. And so that's based on, usually 82 or 85 years, depending on your sex and your gender, right? And then you get the present value from all of that. Now, the bottom there, commuted value represents the amount that could be paid to yourself today in exchange for all the future payments from your pension plan. So some of the key trends that are affecting defined benefit pensions. So like I mentioned there in the last slide, there's the change to the actuarial rate. That's going to be changing in next year, and so that's affecting some people's decision making around taking a lump sum. The second thing is defined benefit plans used to be commonplace in the private sector 30 years ago, but now there is very few defined benefit plans in the private sector. They're mostly defined contribution, which basically means you take on the investment risk and manage it yourself versus having another entity do that. And now, obviously, the public sector does have some defined benefit plans still, but there's some scarcity bias there right now with defined benefit plans. The third thing is that there's low interest rates, and we expect interest rates to be low for the foreseeable future. That affects the payout because the payout is based on that. So that's something to consider, and also it's more difficult for savers just to get money on their cash. The fourth one is underfunding or company credit risk. So a good example of this one is Nortel, when some of their pensioners were affected negatively when the company went bankrupt. The other thing that the companies can do is they can underfund the pension. So this is something that you want to talk, if you're going to stay in the defined benefit plan, you want to talk to the pension to understand what kind of funding level are they at as far as the expected payouts to the pensioners versus the assets that they have. The fifth thing is longevity and healthcare. We're seeing people live a lot longer, and so people are concerned about having that income for a longer period of time. And part of something that's related to that is the timing of that. And so when you have a lump sum payment and you have control over those funds, you can choose to withdraw funds quickly or less quickly, or stop them almost in certain circumstances if you don't need the funds right away. There are some requirements with life income funds to withdraw a minimum amount, and we can talk a bit more about that if anybody has some questions about that. So some of the key personal considerations we'll go through here when we talk with clients about this. No situation is the same. Everybody has different perspectives and priorities that they want to hold up as being the primary and secondary items. So the key thing is to be honest with yourself about what you really want for yourself, your spouse, and your extended family, and then sort of work your way backwards from there. So here we have some reasons to consider your commuted value, and so that means taking the lump sum. So you have independence. So you have the ability to choose when to withdraw those funds or when to keep them in the plan, and you have a choice of your investments and your decisions in that mix. So you have a few more choices. You have lifestyle flexibility. So what we mean by that is, if you say you retire at 60 and you really want to go and travel the world for 5 years, it's going to be a bit more expensive to do that, and your pension won't be able to cover that cost. You might be able, if you have a lump sum and you take out that money, you may be able to withdraw a bit more for a period of time and then reduce that after you're 65 when you decide to just stay closer to home. Right, so that'd be an example. Health reasons, if you're concerned about your own longevity and you still want to leave something to your heirs, this is something that a lot of people, if they're single, they want to leave something to a charity or something else. This is a reason to have a lump sum payment and then control how much can be given to that particular entity. That also relates to the legacy part right below that. So that's something that you need to think about. You also can do stuff when we're considering insurance, and we have a person on our team named Corey who does insurance. And there's other options with insurance that you can create a legacy to, whether you have a defined benefit or defined contribution. So that's just a side note. And then partially protected from creditors, really, that means that certain items are protected from personal bankruptcy if that were to happen. And that includes locked-in retirement accounts, right? So that would be something that you could protect yourself from in case there was something that happened to you personally. And then flexibility. So like we talked about, you can choose when you'd like to withdraw funds. Obviously, there's a minimum amount eventually when it converts over into a LIF at 71. But before that, you can also choose to do that. Now, eligibility for CPP OAS. If you've been working for your whole life, you're most likely eligible for 100% of CPP, and OAS, you're only eligible obviously because income tested until 77,000, and then the clawback starts. For most of our clients, that's not a big concern. They'd rather take a bit extra income and be able to enjoy themselves. But sometimes that is a concern, so that's something to look at. With the choice of choosing when you get your income from the commuted value scenario, you can reduce your OAS callback because you can basically reduce your income amount each year depending on what your needs look like. So here's some of the reasons to remain in a defined benefit pension. If you're very security oriented and you really want to have income guaranteed for your life and including your spouse, if you have survivorship benefits, it's a really good option. You don't have to be concerned with any of the investment or management of the assets, are concerned about volatility in the markets or anything else. If you have a very high expected longevity and you're quite healthy and you want to make sure you have a certain amount of money that's guaranteed for that whole period, it makes sense. Say if you have real estate or other assets outside of the pension that you're going to be giving to beneficiaries or other people for your legacy instead of the pension assets, then it makes sense to keep it in the defined benefit plan. Now we say mostly protected from creditors here. Obviously the Nortel situation is an example where it wasn't fully protected. So those situations can happen, but they're more rare than not. So usually if it's well funded and if it's in a trust structure outside of the company, it's fairly difficult for that company to just go raid the pension funds. The other thing with the DB plan is that if your immediate cash flow needs are very similar throughout your entire retirement period, or you've already saved up money to go on vacation or go do that big trip that you wanted to have, then you don't need to obviously withdraw more money during the first couple of years, and you can keep it like that. Indexation. Now, obviously, if you have investment returns, you're hoping that they're going to be above inflation. A lot of defined benefit plans do have some level of indexation, which is helpful. Although inflation is muted right now, we expect to sort of go back to long-term averages of in between that 1% to 3% in the next while. So if you're really concerned about inflation and that there's indexation in your pension, then that's an added benefit of keeping that defined benefit pension plan. So like I mentioned, we do have a tax and estate professional, Dave, on our team. So I'd forward any specific questions to him, but just going over some of the more global things that happen when you do commute and take a lump sum. Usually there is usually a taxable and non-taxable portion. Sometimes there is not a taxable portion. It really depends on your situation. So the non-taxable portion would go into a locked-in retirement account. The taxable portion, if there is one, would go into your income. And so you want to make sure that you can spread that out if possible. If you're retiring in 2021 and you get that lump sum payment, you try to put that into 2022 or maybe 2023 if that allows. Sometimes they do not allow that, so that's something that you'd have to talk to them about. But you try to spread it out. When you are commuting your pension, there is some tax efficiency, right? So when you think about it, if you have a defined benefit plan, you're going to get, say, that X amount of dollars for the next 30 years. If tax rates on income become higher and higher, you're just going to have to pay those tax rates in 10 or 20 or 30 years, right? Whereas if you take the lump sum payment, you can partially control some of those withdrawals, and then change your tax situation based on those needs. Our view right now is that taxes are most likely going to be going up in the future, and so it gives you just another option to control some of your cash flow and reduce some of your tax liability going forward. So the allowable pension, the non-taxable portion, is determined by an age factor. Your pension plan will do that calculation for you. Obviously, you can't change your age, so they'll have that pretty much set in stone, and then they'll basically give you your commuted value based on that. So if you're older, there's more allowable limit, so the number should be larger. And then there's the pension adjustment. So there's going to be a form from the CRA that comes in and talks about a pension adjustment. So your RSP room is affected based on that. So when we're considering the big picture, you know, we really want to work back through our process, and our process involves your family and your financial goals, and then meeting your retirement income needs in that order. So really, we're going, what's the most important, you know, top 3 things on the financial and then the family side for you, and then we work through that, and then sort of build out that projection or that scenario that really speaks to those priorities. So, and when we have established that, we really review those pension options in that pension option letter, and then see which one works best. As an example, if you have a couple and one spouse has a public defined benefit plan, and that person's already taken it, and the other person has a private sector defined benefit plan, and both the couple's fine by keeping just the one plan in place because they want some income security with that, you know, sometimes the option is to do a lump sum payment for that other person, as an example. So really the purpose of this webinar is really to give you some more information and sort of structure those conversations to have a good way of understanding what are the pros and cons of each side, and starting that conversation, you know, with your spouse or your family, to make sure that you really understand where your priorities are and how your financial and family choices can be best lived out in your certain circumstances. I wanted to just take a moment here to talk about the team that I'm involved with. It's not just myself. There's 3 advisors, myself, Sam, and Ian, and then we have two associates, Shay and Diane, and then we also have an insurance and tax professional, which I already mentioned, Corey and Dave. So we're an Alberta-based group in Red Deer here, and we also have, you know, clients around, you know, if you took a pin and put it in Red Deer, 300 kilometers in any direction in Alberta. So part of the thing that we do as far as what our key differentiators are is that we're independent in thought and action, meaning so our investment selection is not related to National Bank at all or any other group. We select the best products for our clients. We have full alignment with you, so we actually invest our funds the exact same way that your funds are invested, and you have a full access to our whole team of professionals to sort of enable you to get to you where you want to go. So we call that a full service approach. So we're here to partner with you so that you can get to where you want to go. The other thing that I wanted to mention, if you have commuted your pension, it would be a good time to talk to us just to understand what can you reasonably withdraw from that for the period of time that you expect to be around, and what your legacy and other goals look like, right? So if you've already made that decision, that's good, but we want to understand, what would be the, a sustainable way to deal with that, and how does that affect your full financial picture? So we can also talk to you about that. We want to thank you for attending today, and stay safe and healthy over this Christmas holidays and New Year's.